Why capital is outpacing infrastructure capacity. Capital is still moving decisively into buildings. Electrification retrofits, efficiency upgrades, digital controls, and resilience investments continue to clear internal approval gates across commercial and institutional portfolios. What is not keeping pace is the infrastructure those assets depend on. This mismatch is becoming one of the most underappreciated risks in capital planning. Buildings are being modernized on timelines measured in quarters, while grid, water, and distribution infrastructure upgrades operate on timelines measured in years. The result is a widening exposure gap, one that rarely appears in project models but increasingly shows up in execution. Building investment is outpacing system readiness. Building upgrades are attractive capital targets for a reason. They have clear ownership, defined scopes, measurable returns, and often regulatory or incentive support. Compared with infrastructure projects that span jurisdictions and approval layers, building investments move quickly. But speed has consequences. Analysis from McKinsey & Company shows that while capital continues to flow aggressively into electrification and building upgrades, infrastructure expansion is lagging at the local level. The result is execution risk that is frequently underestimated in financial planning, particularly where availability of grid or water capacity is assumed rather than verified. From a capital perspective, the asset performs. From a system perspective, capacity is not guaranteed. The hidden cost of waiting on capacity. Infrastructure constraints rarely appear as a single visible failure. Instead, they surface as partial execution. Projects approved but downsized, equipment installed but underutilized, timelines extended without a clear accounting impact. Boston Consulting Group has identified infrastructure readiness as one of the most common blind spots in decarbonization and modernization strategies. Asset-level returns often assume system capacity that does not yet exist, forcing organizations to absorb delays and risk at the building level rather than where the constraint actually sits. The cost shows up quietly: stretched payback periods, stranded capability, and reduced operational flexibility. Infrastructure delays are becoming capital risk. This is no longer just a coordination problem, it is a financial one. Moody's Ratings has increasingly linked infrastructure reliability and upgrade timelines to credit outlooks, particularly where uncertainty around capacity introduces long-term cash flow risk. When infrastructure delays affect utilization, resilience, or service reliability, the impact extends beyond operations into financing assumptions. For capital planners, this shifts infrastructure from a background condition to an active risk factor, one that is difficult to hedge once funds are committed. Why the gap is widening, not closing. The widening gap between building investment and infrastructure capacity is not temporary. The World Economic Forum, WEF, has repeatedly warned that electrification ambitions are advancing faster than infrastructure investment globally, creating coordination risk between public planning cycles and private capital deployment. As more capital moves downstream into end-use assets, the strain on upstream systems intensifies. At the same time, deferred infrastructure investment compounds the problem. According to the American Society of Civil Engineers, much of the nation's energy and water infrastructure is operating beyond its intended design life, limiting its ability to absorb new loads without significant reinvestment. This is not a temporary lag, it is a structural imbalance. What strategy teams are beginning to reevaluate? For executive and finance leaders, the question is no longer whether building upgrades make sense. It is whether those investments are being sequenced realistically against infrastructure readiness. Deloitte has noted that many organizations continue to plan building investments in isolation from system constraints, increasing exposure when projects reach execution and infrastructure capacity proves insufficient. In response, some organizations are pulling infrastructure coordination earlier into capital planning. Others are stress testing projects against multiple capacity scenarios rather than assuming baseline availability. A smaller but growing group is prioritizing resilience and alignment over speed, even when incentives favor rapid deployment. These shifts reflect a broader recognition that infrastructure is no longer a neutral backdrop for capital deployment. It is an active constraint, and increasingly, a strategic one. The signal heading into next week. What appears today as project friction or delayed execution is pointing toward a deeper issue. Capital continues to flow into buildings faster than the systems beneath them can realistically support. As infrastructure constraints move from operational nuisance to financial risk, organizations are being forced to confront a question that will define the next phase of sustainability and resilience planning. Not how fast assets can be upgraded, but whether the systems they rely on are ready to keep up. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.